Warren Buffett is widely considered to be among the greatest investors of all time, quite possibly the greatest. I understand that many people may disagree with that statement and his strategies, but it is hard to argue with the results. In 2008, he surpassed Bill Gates to become the richest person in the world, according to Forbes, and even though he has since fallen to number 5 on that list, his net worth has more than doubled. In 2024, his holding company, Berkshire Hathaway, was the 7th company to surpass $1 trillion in value on the stock market, and the first one to do it that is not considered to be a tech company. Berkshire Hathaway has a reputation for being really good at seeking out investment opportunities. He fully admits that they have not all been winners, but over the past 60 years, Berkshire Hathaway has seen a 5.5 million% return, which far exceeds the overall market in the S&P 500. In the very early days, he used more of a cigar butt investment strategy, is what they call it. The idea is that he would seek out a struggling company, invest in it at a cheap price, and sell it at a profit as soon as there is any kind of increase in value for whatever reason. As Warren Buffett himself puts it, a cigar butt found on the street that only has one puff left in it may not offer much of a smoke, but the bargain purchase will make that puff all profit. But in the 1960s, he was influenced by Charlie Munger, who became sort of his right-hand man, to switch his strategy toward long-term value investing, which in many ways is almost the opposite. Traditionally, Berkshire Hathaway seeks out investments with strong, established brands, many of them dating back to the 1800s. As I am making this right now, Warren Buffett is 94 years old, and I do think that has worked to his advantage. He has been around for so long, watching all of these brands and experiencing their impact as it evolves through the decades. I think giving him an unusual advantage in evaluating them. He looks for a management team that he trusts, because typically Berkshire Hathaway has a hands-off approach where those existing managers will continue running things after it is taken over. He tries to catch these brands at a time when they are undervalued or at a low point, so he likes to keep a lot of cash available so he could take advantage of these opportunities when they present themselves. He has said it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. You might have to think about that for a second, but it really does summarize his overall mentality toward investing. He even wants investors in Berkshire Hathaway to be serious long-term investors, and part of that has been refusing to split the stock. When a stock price gets high enough, companies will almost always do a stock split, increasing the number of shares but lowering the price per share. Since Berkshire Hathaway is different in that they do not want to make it easier to trade, it has gotten really expensive. In 2006, their Class A voting stock became the first US stock to surpass $100,000 per share. Today, it is trading at over $700,000, and they have not declared dividends since 1967, believing that investors will benefit more in the long run if that money is reinvested as opposed to being distributed. Now, as you could imagine from everything I've been saying so far, Berkshire Hathaway has invested and divested in hundreds of companies over the past 6 decades, so I'm sure you could understand that it would be impractical to go through all of it. To keep things simple, I want to outline 12 companies acquired by Berkshire Hathaway that stand out to me as either being the most recognizable, the most impactful, or simply that demonstrate the wide range of businesses that have helped to build it. Berkshire Hathaway was officially formed in 1955 when Berkshire Fine Spinning merged with Hathaway Manufacturing. Both of them were large New England-based textile companies that were having trouble. For multiple reasons, the entire industry in the northern part of the country had been going downhill for a long time, so even though the resulting company was large, it was aggressively downsizing without much promise for the future. Over the next decade, the value of it was more than cut in half, and Warren Buffett's investment group saw it as an opportunity to buy enough stock at a reduced price to take it over. And that is going to lead me right into the first acquisition on my list, National Indemnity. It was an insurance company based in his hometown of Omaha, Nebraska that he bought for $8.6 million. This right here might just be the most significant one because it was their first involvement in the insurance business that has sort of acted as a foundation for them to get involved in other businesses. purposes. Float is the term for money that the insurance company possesses that has been paid by customers through premiums that has not yet been paid to customers in the form of claims. I hope that makes sense. In short, insurance companies typically have access to a lot of money that could be invested, and as Berkshire Hathaway has grown their insurance business, the float has grown along with it. When they first bought National Indemnity, their float was $16 million, and today it is around $171 billion. For their second major acquisition, they bought See's Candy in 1972, and this is where Berkshire Hathaway really started implementing that value investing strategy. See's Candies had been established 50 years earlier by the See's family, and had gained a reputation for making quality chocolate. The See's family was looking to sell it, and it reportedly helped Warren Buffett and Charlie Munger see the value of a wonderful company at a fair price for the first time. They paid around $25 million for it, and at this point have officially owned it for longer than the See's family did. Going back to the list, in 1985, they made a much larger acquisition when they paid around $320 million for Scott and Fetzer, which in itself is not a strong brand, but they were the owners of Kirby vacuum cleaners that they held onto for the next 36 years and World Book encyclopedias. Warren Buffett said that he saw value in those encyclopedias, considering that he had used them since he was a kid and his grandkids were currently using them. I guess they seemed like they would be timeless. However, after a few strong sales years, the internet really hurt encyclopedia sales in the 1990s, and it became an issue for them. Next up on the list, in 1995, they acquired Helzberg Diamonds, a jewelry retailer with 146 stores found in 23 states at the time. I do not have too much to say about this one, but I wanted to include it because it shows how diverse they are, that they were willing to buy a major chain of jewelry stores because it was a strong, established brand that went back 80 years. This also marks a point where the acquisitions are going to start getting bigger, because in the 1990s, Berkshire Hathaway shifted toward full acquisitions, taking over the entire company as opposed to smaller portions of it. Later in that same year, they also acquired Geico Insurance, not only the company behind some of my own personal favorite commercials. This was easily one of the most impactful, solidifying them in the insurance business, and it was a long time in the making. Warren Buffett claims that in 1951, when he was 20 years old, he invested half of his net worth in Geico. In the 1970s, they bought a significant portion of it, and by 1995, they had already owned 51% of it when they paid over $2 billion to buy the remaining 49%. Back to the list, in 1997, Berkshire Hathaway paid $585 million to buy the country's largest franchisor of ice cream restaurants with over 5,700 locations, Dairy Queen. Yet another classic brand that Warren Buffett himself had been visiting for decades. Alright, that was the halfway point of the list, and I think the pattern is starting to become clear, so I'm going to go a little bit faster for the second half. In the year 2000, for the price of $1 billion, they acquired Benjamin Moore, one of the country's oldest and most recognizable paint brands going back to the 1800s. 2 years later, they acquired the classic clothing brand, also going back to the 1800s, Fruit of the Loom. They were coming out of a bankruptcy, so they had lost a lot of value, and Warren Buffett believed in the CEO that was running it, so they paid $835 million to fully take it over, and they have owned it ever since. By the way, let me know if you would like to see a video dedicated to Fruit of the Loom, because there is some interesting stuff there. In 2009, they bought Burlington Northern Santa Fe Corp., the country's largest railroad, for $34 billion. It was their largest deal ever at that point, paying a 31% premium, in a move that was seen as a gamble on the US economy when it was at a downturn, and the importance of railroads remaining a big part of it. 4 years later, in 2013, they teamed up with a private equity firm called 3G to acquire Heinz. It was a $23 billion deal in total that clearly included a lot more than just the ketchup. I recommend this video I made about Heinz if you want a better understanding of the extent of it. But only a couple years later, Heinz merged with Kraft, and so far, I'm just going to say that it has not been shaping out to be one of their most lucrative deals. In 2014, they acquired Duracell, the battery brand, in what was kind of a tricky deal. Going back to 1989, Berkshire Hathaway had invested in the razor brand Gillette. By 2005, they were Gillette's largest single shareholder, owning almost 10% of it, when Gillette was bought by Procter & Gamble. In exchange for giving up their portion of it, Berkshire Hathaway received stock in Procter & Gamble, and even bought some more of it following the deal. So in 2014, Berkshire Hathaway traded those shares back to Procter & Gamble in exchange for Duracell. Finishing up the list, in 2015, 2017, they acquired Precision Cast Parts. They make nuts and bolts and pipes, and I wanted to include it here because it became their new largest acquisition. In addition to all of this, Berkshire Hathaway has also spent billions of dollars to acquire multiple insurance companies, energy companies, media companies, and have been involved in major acquisitions between other companies, like when Disney bought ABC in 1995, or when Mars bought Wrigley Gum in 2008. It feels like a never-ending list, because on top of all of that, Berkshire Hathaway has had significant minority investments in some of the largest companies out there. Some of the more notable ones include Coca-Cola, starting in 1989, American Express, starting in 1991, Goldman Sachs, starting in 2008, and of course, Apple, starting in 2016. For each one of these, particularly Apple, they have made billions of dollars, in addition to many others. Like I said, it seems like a never-ending list that is impractical to fully cover in this video. It is almost overwhelming. So if there is anything else that they have been a part of that you feel is worth mentioning, please do not hesitate to bring it up. And also, let me know in the comments, what are your thoughts about Berkshire Hathaway and its long-term value investing strategy? Has it been more skill or luck responsible for the success? And what do you see for the future of it? The reason I wanted to make this video right now is because Warren Buffett has recently announced that he will be retiring soon as CEO of Berkshire Hathaway at 94 years old, I will remind you, but will remain chairman. Only 2 years before, Charlie Munger passed away at 99 years old, so Berkshire Hathaway will soon be without either one of the main people that have been responsible for its growth and success. The obvious question here is whether or not his replacement, Greg Abel, and the rest of the remaining management will be able to continue on the legacy and live up to those outrageously high standards. Where do you see things heading from here? And any other thoughts you have about Berkshire Hathaway or any of the other brands in this video, leave them in the comments. I'd like to hear what you have to say.
Will you marry me? Ooh, Hellsberg diamonds.
Yeah, well, he must have saved some money with Geico.
Thank you for watching.